What is going on, investors? Back again. Time to take a look at another stock today. We're going to take a look at Target Corporation, ticker symbol TGT. They reported earnings yesterday. Wish I could have gotten to it yesterday. Ran out of time, but we'll take a look at it today. The stock's actually pulling back just ever so slightly, but it made a really monster move. When we jump into the stock chart, we'll see the gap up that this stock made after they reported earnings. We'll talk about the stock chart here in a little bit. But broadly, this is a $76 billion company, and compared to Walmart, that's actually a pretty reasonable market cap, at least compared to Walmart. Now I know Walmart's a lot bigger, so maybe Target can grow into a valuation closer to where Walmart is. From a price to earnings ratio, it's not completely out of whack. I mean, this is not necessarily cheap in some people's eyes, but a 28 PE, not too bad. And we do pay a dividend of $2.72 per share. When we jump into the financials that they just reported yesterday, we'll take a look at what kind of coverage they got. That's a 1.76% dividend yield. Maybe that can get a little bit juicier, obviously, as we move forward. Now, the first thing I want to make you aware of is this just really interesting tweet by someone called Jason Goldberg. He's a retail geek on Twitter and is one of the foremost experts on e-commerce and commerce in general, and somebody that I'll show you where you can find more information about him in a minute. But he said no CPG, which is consumer packaged good, has built a $1 billion brand in 5 years. So no CPG has built a $1 billion brand in 5 years. No new DTC, which is direct to consumer. So no new DTC has generated $1 billion in annual sales. Okay. Target launched Good and Gather. So this brand down here, that's like a food brand, in September of 2019. So not even like a year ago. And has already surpassed $1 billion in sales. Its sixth $1 billion brand. So Target has six $1 billion brands, and one that they last year is already surpassed $1 billion in sales. I just thought that was a really interesting antidote, and it obviously provides a lot of tailwinds behind Target, and it might justify why this stock has been on a tear, and it might actually justify maybe a little bit higher PE ratio if they're churning out these brands like that. I'm sure the margins on those have got to be relatively good. Now, if you want to find out more, I actually highly recommend, again, this guy that tweeted this out, Jason Goldberg. Just as a side note, he has his own podcast that I've been listening to for years. I mean, 5-6 years. I think I listened to it right when they had their first couple episodes. They're 232 episodes deep. They interview a lot of people. Like, they'll break down Amazon earnings. They'll just do a lot of stuff here. They talk about all the Amazon news, Target, Walmart, anything, and then even a little bit smaller brands. So that's the Jason and Scott show, and you'll be able to find that. I'll try to put a link to this in the description below so you can get to that if you want to. So now jumping over to Target. Okay, so we've got revenues here. We've got sales here. 3 months ended here. 6 month ended here. I love it when they do percentage change here, because we see we're up in the quarter close to 25% for 3 months sales. On a 6 month basis, we're up 18%. That's really solid from a company this side. We obviously know a lot of the driver is because a lot of their competition, quite frankly, is closed or going out of business, things like that. They were one of the few stores that were allowed to be deemed quote unquote essential and essentially stay open. So, boom, those are some really good sales. And I think in this quarter, you even had a little bit of the social unrest as well that caused some of the Target stores to be closed. So, they actually had really good performance despite all the kind of things that were happening in the quarter. Now, total revenue down here, we got a little bit of other revenue. That might be credit card, interest and things like that they have on that Target Red Card. Now, cost of sales. Again, this is not a high margin business. This is not a software company, but these are relatively decent margins, okay? And they're 24% change. So we've ticked up a little bit, but again, it's moved in line with our revenue jump. And so you like to see that they're keeping margins consistent. That's not always the easiest thing to do when you have those types of, when you have all the stuff that we have going on as well. Now, selling general administrative expenses, these actually ticked up at a slower rate than I would have thought. I would have thought with all the employee safety measures and all the stuff that they have to do, they've actually kept these well within line. And so that's a really, really nice sign. line. Now, operating income we see here is up huge, 73%. We grew sales 24%. Our operating income has up 73%. So this is a blowout quarter. This kind of reminds me of the quarter that Home Depot just had. If you want to check our most recent videos, I just did one on Home Depot where they grew sales right in, I think, this 25% range, and then their operating income just blew it out of the park. So they're firing on all cylinders, and so is Target. For the 6-month view, not quite as awesome, but still pretty good. We grew operating income here by 12%. That's really, really nice. Now, coming down to net earnings, we'll just come all the way down to the bottom line. Look at this. We grew it 80% in the quarter. It was just absolutely just again, just like Home Depot, just a blowout quarter, and the stock just had a blowout top. As we get over the stock chart, we'll take a look at that. Now, from a 6-month view, it's not quite as great, but it's still really strong. We grew at 13%. Company this size, growing that quickly is really, really, really nice. So now, from an earnings per share perspective, so for 6 months ended, we had $1.34 that's dividends. So we've got earnings per share up here. So we earned $3.91 and we paid out $1.34. Okay, so for the quarter, we earned $3.35. Take a look at that. Man, that's huge. That's a big jump. And we paid a dividend of 68 cents. Now, I know this quarter is somewhat of an anomaly. We can even go back to the previous period where things aren't as weird as they are now, where we made $1.82 and we paid out 66 cents. So this is a company that has tons and tons of room to increase this dividend going forward. Not necessarily something that they should do or have to do, but you as an investor, if you are buying a little bit or for most of this yield, the yield has shrunk as this stock has really took off. I remember when this stock was actually a quote unquote high yielder because the share price was a lot lower and the dividend was still pretty high, but they've got nice coverage here. Everything looks super, super strong. From the asset side, we go from August previous year to current year, and then we go, this is like February to August. So that is like 6 months there. So we, year over year, quarter over quarter, 6 month over 6 month, we're up on the cash. I'm wondering where that's coming from. I would guess some kind of financing raise. While they had really strong earnings, I don't think it all flowed to this top line of cash here. Inventory, that's something you always want to keep an eye on. It actually has ticked down just slightly from 6 months ago and then a year ago as well. So they're managing their inventory really well. I think that's both a positive and a negative. If they're out of supply on things that could drive more sales, drive more traffic into the stores, that's a problem. But at the same time, they're not overstocked on things as well, at least from an inventory perspective. They've kept things really nicely. They've kept their supply chains open, which is someone who is involved in e-commerce like myself, it's not easy. There's a lot of stuff from the supply chain that has really been disrupted. And so the fact that they're keeping inventory at this level is actually pretty nice. Now, all this other stuff looks pretty good. From a total assets perspective, we ticked up almost in relation to what we did with the cash. Now, total liabilities. So yeah, we have this long-term debt here. We see that's ticked up over the last 6 months, and then over the last year, we ticked up by about $3 billion, which is close to here. So some money flowed. Some money from the operation looks like it probably flowed to cash, but a lot of it too is coming from this long-term debt borrowing as well. Everything else looks pretty solid to me. Man, this is not that bad. We've got, total liabilities, total non-current liabilities here at $19 billion, total current liabilities here at 15. So that's not a ton of liabilities, from this perspective here. That's not that bad when you're considering what they have in cash, what they've got in inventory, other assets as well. This is a really strong balance sheet for a retailer. This is going to position them beautifully as a ton of their competition goes by the wayside, has struggled through the pandemic that we're in. This is a company that is well positioned from a balance sheet perspective. Now, from a cash flow perspective, probably paints an even bigger picture. So on cash flow statement, if you don't know this, usually it's a 6-month view, not all the time, but usually it's a 6-month view. So we pull these down. What we do is we pull net income down, and then what we do is we add back in some things like depreciation and amortization. It's not necessarily a cash thing. Share-based compensation, that's obviously not cash, although I'll always make the argument that you got to pay your employees somehow, whether you're paying them in Target shares or cash. To me, it's almost the same thing. Just take all this with a grain of salt. You've got accounts payable where you haven't necessarily paid this money yet. Okay, you're going to pay it, but you haven't paid it yet. So it kind of gives cash flows is mildly deceiving, and it's not always the best way to analyze a business, but it does give you an idea how healthy the business. Sometimes companies can manipulate the net income number, certainly manipulate the earnings per share number. It's a little bit harder to do on cash flows. At least you can get a little bit bigger sense of it. So we made 2.8 in the previous period. We're up to 5 billion in this period. Obviously, that's a blowout quarter. And then finally, on cash flows, what I often use it for is to take a look at what happened on the financing side. The investing side with a lot of companies tends to be pretty consistent. We see property and equipment that Target spends money on, whether it's their build outs or their buildings or their employees or their fulfillment centers, things like that. Well, it's stayed relatively consistent. Money's going to flow out there. But on the financing side, you see, you got long-term debt here. We got payments of long-term debt. So you see they were paying it a little bit more down in the previous period. We didn't do it as much here. We issued a lot more debt in this period versus last period. We've got dividend pays here. We got repurchase of stock. So they're purchasing some stock back along with paying these dividends. That's two things that are positive for you as a shareholder. And then you've got some stock option exercises, but these are relatively minor. And then finally, you can see net increase in cash. So you can kind of see like how cash moved, and then you have the cash and cash equivalents, at the different periods as well. So that's what you can get out of the cash flow statement. Now, what can you get from this stock is absolutely sensational performance. We made a low down here at $90 like a lot of stocks, and it's been, a lot of stocks have kind of been straight up and down. It actually was in a trend. Target made an immediate trend here, and then really it actually broke down. The stock actually broke down and then kind of channeled sideways for a while, and then it started moving up, started creeping up as we started getting close to earnings. I wonder how much of this is insiders knowing what's about to be released on the earnings, and then boom, earnings get released here, and then we have this massive gap up. And so if you know how to properly trade stocks or buy stocks when they gap up, by all means, if you like what the formation that this stock and this price chart is making, by all means, jump into Target. Me personally, I don't like to buy stocks when they gap up and then move up. Okay. To me, there's this gap here. And one of the reasons why is I have these lines here this is back in 2019, around this time, actually. So we had a gap up here. So I have this line pointing to this gap right here. So we gapped up, probably off earnings or something. And the stock went sideways for a little while. And then what happens is we gap back down, and that gap down almost coincides directly, and the fill of this price action comes and fills this gap. So that's personally what I would look for with Target, is for the stock to, and I'm not saying this is what's going to happen, but me personally, I would wait until we saw the stock come back and fill this gap at the 138, 139, 140 range. That's potentially what could happen. I'm not saying that's what could happen. I did see some commentary on the call. So management of Target did say that stimulus checks are critical to continuing the momentum that they had in the quarter. Okay. And we saw a similar thing from the Walmart CEO. The Walmart CEO said the exact same thing on their call, that stimulus checks really drove a lot of spending at Walmart, and it drove a lot of spending at Target. If those stimulus checks are not renewed, I'm not saying that Target stock and Walmart stock will sell off rapidly, but it will negatively impact their quarter and the subsequent quarters for the future. And then finally, we've got this MACD way overextended. Look, anytime this stock, anytime the MACD kind of comes up here, the stock wants to either go down or sideways. And I'm not saying that's what happened. See, the MACD kind of peaked out here. What happened? The stock went sideways, and then it retraced a little bit. Here, the stock stock went sideways, but then it bottomed out here and then went back up. So that's what I personally would be waiting for with Target. If the train has left the station on you, unless you really effectively know how to, trade and buy these breakouts, I personally would avoid it. Now, personally, I own Target. I had Target shares at like $50 a share, and I had like 20 of them. And sadly, we could play some sad music, I guess. I sold them and they're gone. So I don't have any Target shares now. And obviously, I'd be sitting pretty nice if I still had those shares, but stupidly, I sold them, I guess. Hindsight is 2020. But this is a stock, to me, really nice. If you want to build a portfolio of retailers, you got Amazon, you got Walmart and Target. I think if you own those three in tandem, you are going to capture a huge amount of the retail here, not only in the United States, but you'll capture a certain percentage overseas as well. But particularly if you want to capture, if you think retail has got a bunch of tailwinds behind it, building a portfolio of Target, Walmart, and Amazon would be an ideal situation. Don't look at them like competitors, like you're rooting for the Yankees or the Red Sox or the Lakers or the Celtics. Don't look at it like that. These companies, as we can see, if we brought up all their stock charts have been winners over the last, especially the last 3 to 4 months. Okay. All these companies can survive. And my suggestion, if you want exposure to all of them, feel like you can do that. You're going to have a little bit of overlap, but don't look at like one company is going to demolish the other. I don't see that happening with Walmart, Target, and Amazon. I think they're all three just gobbling up the weaker competition while they are getting stronger. So there you go. That's Target. Like this stock, it's run away from us a little bit. Maybe leave me a comment below telling me how you would trade this one. So there we go. Hopefully you guys enjoyed this one. We'll be back again soon. Good luck with your investments.